Hey guys, Daniel here with Value Investing with Daniel. Thanks for tuning in. In this video, I wanted to go over, because I had some people asking both on Reddit and here on YouTube, what a good rate of return is for investors investing in common stocks in the form of value investing, following the modern value investing philosophy. In terms of the rate of return that we're aiming for, it will really depend on the amount of capital that you're working with. So the more money you have, you know, the slower your rate of return is going to be. And that's simply because the universe of stocks that you have to work with is going to be smaller and smaller the more money you have. So I'll give you an example. If you have, and this does not mean like if you have $50,000 or if you have $100,000, there's going to be a difference. There won't be. But if you're comparing dealing with $100,000 versus 100 billion, then there's obviously going to be a substantial difference. And the reason is, there's just not that many companies that you can spend your time analyzing when you're dealing with more than $1 billion. But when you only have $100,000 or $1 million to work with, you can basically invest in any company, all the micro caps and so forth. But if you have $1 billion, you can't waste your time because you got to allocate that $1 billion somewhere. And chances are you can't be wasting time looking at companies with market caps of only 50 or 100 million when you have $1 billion or $10 billion to work with. So I have a chart here basically of what I think appropriate rates of return are depending on the amount of capital that you have to work with. I think, and this is based on my sort of analysis of different investment professionals and what they've been able to deliver with different amounts of capital. But I definitely think working with under $100 million, it's very feasible if you are diligent, hardworking, disciplined, intelligent, and have your emotions under control to return about 30% per year if you're dealing with less than $100 million. But for all these rates of return, you have to be good. Like, you cannot just read like one book or watch like a YouTube video and somehow think you're going to emulate Warren Buffett. Like, you read the Warren Buffett way and all of a sudden you're going to be like a super investor. It's not going to happen. Like, you really have to dedicate yourself. But I think if you do and you're working with less than $100 million, I don't see why you wouldn't be able to return 30% per year on average. Obviously, some years will be better than others. But in order to do this, like, you have to dedicate yourself fully to this. So basically, if you're working with less than 100 million, I think averaging 30% per year is not ridiculous or outside of the realm of possibility. And these are really like maximum feasible returns. If you're dealing with less than 100 million, probably even if you do 25% per year, it would be still extraordinarily good. But if you're working with less than 100 million per year, you're only doing 15% per year. I mean, you have so much opportunities out there in terms of the market. You should be able to outperform. So 100 million per year or less that you're working with, roughly, I think you should be aiming for a 30% per year annualized rate of return on average. If you're dealing with 100 to 500 million, your universe will shrink in the sense that you can no longer really go for like those micro caps anymore, where a lot of the greatest bargains exist. And a lot of like the sort of local monopolies and local competitive advantages end. And so your universe of stocks will shrink. And in that case, I would expect your maximum possible attainable rate of return would probably fall to about 25% per year. So, when you're dealing with this amount of money, like between 100 and 500 million, if we look at the results of other really great investors, they seem to have this sort of block at 100 million where it really starts to turn down the rate of return, only because like their investment universe now is starting to really get a little bit smaller. And so, you would expect your maximum possible rate of return to still be about 25% per year, but that's still a fantastic rate of return. And that's like really the maximum I would expect somebody to be able to deliver. When you're dealing with between 500 million and $1 billion, again, your investment universe just starts to shrink exponentially as you're going along. You should be aiming for about a 20% annualized rate of return, I think. And when you're dealing with more than $1 billion, I think trying to just beat the S&P 500 by a couple of percentage points, like 15% per year, which is basically outperforming the S&P by about 5 percentage points, I think would be absolutely fantastic still. So keep in mind, when we're discussing what ideal rates of return are, you have to contextualize it within the framework of the amount of money that you're working with. Less than 100 million per year, you should be aiming for a 30% annualized rate of return. More than $1 billion, now your universe shrinks substantially and you're really looking at a 15% per year annualized rate of return. Keep in mind that these are idealized numbers, right? This is what we're aiming for. Just like, you shoot for the moon, you aim at, or whatever, you shoot for the stars and you land on the moon or whatever, right? It's the same thing here. So we're aiming for 30%. If we get 22%, we're still happy. That's still a fantastic rate of return, right? We're aiming for 25%, but we get 19. That's still a fantastic rate of return. So these are really like the upper limits, I would say, more than anything else. But I hope this sort of put things into context for you, what you should be aiming for as an investor. Your investment philosophy will not change substantially. It's just that the realm of opportunities, the amount of opportunities will increase with the less money that you're working with. The more money you get, the harder it is to find good deals. The less money you have, now you can invest in a lot more opportunities. You might find with less than $100 million per year, you could ideally find 5-6 good investment opportunities per year. But when you're dealing with more than $1 billion, if you find one good opportunity per year, it was a good year. So keep that in mind. I hope this video was informative, and I hope now it's a little bit more clarified as to what your ideal rates of return should be. So thanks for tuning in. Please like and subscribe.